Welcome, dear traders. We are watching a recap of the Asian session. The US stock market has been rather volatile at the beginning of the week. However, volatility is likely to ease in the US session today. By the evening, traders will have finally learned the results of the FOMC meeting. The Fed may also reveal the pace of a further monetary policy tightening and how many rate hikes it may undertake. Usually, movements of assets in the Asian session somewhat depend on the sentiment on Wall Street. However, the Asian session was unfolding quietly today, and let's discuss its main highlights. The Fed announced its plans to raise the interest rate in March. It also hiked the cash rate by 0.5% back then. Apparently, the first rate increase was rather modest and insufficient to curb inflation. Since then, consumer prices have approached new highs. Oil and food prices have risen considerably. Global markets are also facing headwinds as investors are worried about the crisis in Ukraine. They realize that the situation may worsen there rather quickly. This is why the Fed's soft landing looks highly unlikely. Inflation has already hit a 4-decade high. Besides, growing uncertainty in the global economy may also pose great risks to the United States. This is why the regulator should be extremely cautious. Market uncertainty is primarily weighing on stocks. Investors have been getting rid of some shares for several weeks. Higher interest rates will significantly limit the possible profit of risky stocks. As a result, the Nasdaq closed 13.3% in April, logging the worst monthly results since October 2008. Yesterday's session on Wall Street was also volatile. However, the main stock indexes closed in the black. They have experienced sharp swings recently. Shares of financial and tech companies were in a high demand among investors. The US dollar has benefited the most from soaring inflation. The main driver for bullish momentum was the Fed's hawkish rhetoric. The watchdog pledged to take more aggressive measures compared to other central banks. The US dollar index reached a 2-decade high last week amid expectations of more rate hikes. However, analysts are concerned that the majority of market participants have already priced in the Fed's monetary policy tightening. So it's possible that the bullish trend for the United States dollar may slow down. It can be seen today on the chart. In the Asian session, the US dollar is trading mixed against its main rivals. It was consolidating in a narrow daily range of 103.38 and 103.60. Yet the bullish bias remains strong, so at the moment of preparing material for this video, the US dollar index was hovering at 103.41 with the prospects of a further decline. Trading floors in China and Japan are closed on holidays. China celebrates Labor Day today, while Japanese traders are often on the Golden Week holidays. This is why stock markets are less volatile. However, in Japan, the market sentiment will hardly change after the long weekend. The Bank of Japan stubbornly sticks to an ultra-soft stance, despite the shift of other central banks to a more hawkish approach. The regulator proceeds with a buying on unlimited quantity of 10-year treasuries at a fixed rate. The Bank of Japan also made it clear that it would not hike the key rate in the near future. Yet it refrains from any currency interventions. The dollar-yen pair soared above 130 for the first time in 20 years amid the Bank of Japan's dovish rhetoric. However, the 130 level was become just a new low. Previously, analysts considered it a critical threshold. This new low is quite acceptable for the pair at the moment. However, yesterday, the dollar-yen pair declined to new lows, testing the level of 129.75. The pair closed Tuesday at 130.20. 12. In the Asian session, the pair was moving steadily in the price corridor of 129.97 and 130.20 as the greenback remained in the narrow range. At the time of preparing material for this video, the price was consolidating at 130.04. Unlike the Bank of Japan, the Reserve Bank of Australia has decided to begin the monetary policy tightening cycle. Inflation in the country hits new record highs. The economy is getting stronger. Yesterday, the regulator raised the key rate by 25 basis points, catching traders off guard. At the same time, the Reserve Bank of Australia did not specify on how much it could hike the interest rate next time. However, traders have already learned how to read between the lines. For this reason, many speculators assessed the Reserve Bank of Australia rhetoric as more aggressive. It was quite bullish for the AUD. The AUD USD pair jumped to a high of 0.7147. Analysts do not exclude a further rise of the pair, even though it lacks drivers. Apart from volatility in stock markets, geopolitical worsen and worrisome epidemiological situation in China, headwinds in the domestic market may also undermine its rally. Of course, the Reserve Bank of Australia may start raising the rate at every meeting. However, traders could have already factored it in. It was also the main reason for its recent sharp increase. In the Asian session, the pair maintained its upward momentum despite volatility in the stock markets. It was moving between the resistance level of 0.7089 and the support level of 0.7123. At the time of preparing material for this video, it approached the level of 0.7116. And that's all for now. As a reminder, we will be happy to read your comments down below. Share your opinion and ask your questions. Our analysts will try to answer them all. Do not miss our next video review and see you soon.